All right, hello again, guys. Okay, this is going to be a fairly short video just on stocks. So we've already discussed that we know, oops, sorry, I keep clicking things. Okay, there are many types of investments. Stocks tend to be one that people are familiar with the concept, but it's not always the best way to invest if you are trying to be less risky. Because as we saw on the chart, stocks are viewed as one of the higher risk forms of investing. Okay, hopefully you've already watched the investing basics video I gave you on stocks, and this will just be somewhat of a refresher. Okay, so what is a stock? When you are purchasing a stock, you're really purchasing a piece of a company, okay, or a share of that company. So you are really owning a small fraction of that company's assets. So you can buy into Apple, you can buy into Starbucks, but you're really buying a very, very small fraction of that company's assets. If the company is doing well, the stock should go up. If the company is not doing well, the stock may go down. Okay. Now, the more shares that you have in that company, the more ownership you would have. Now, in terms of the price of a share, this is going to vary a lot from company to company, and it's going to go up and down, minute by minute on the open stock market, depending on how the company is doing. So you don't really want to get too focused on the small changes of stocks. You want to look more for the overall trend. Okay. Now, stocks can be a very high risk investment because if you were to invest in one company and that company didn't do very well, you could really lose quite a lot of money. But they have the potential to offer very high returns. So think about if you were some genius that invested in Apple, say back in, I don't know, when did they start? 2008, something like that. You probably would have been able to buy in fairly low, and their company has been crushing it, and that stock price would have increased a lot. All right, now you really don't make your money on your stock until you sell. So you've got to make sure you are, buying and selling appropriately. So stocks are considered an active investment, which means you kind of have to pay attention to them a little bit. You want to make sure that you are buying low, selling when that stock is high, and you got to just kind of be a little bit more aware of the stock prices. Okay, it doesn't necessarily mean daily. There are day traders, but they will involve a bit more work potentially on your part. Now, I just want to show you this kind of info down here. I'll show you a stock chart in a minute. This is just one screenshot. So this is a clip of the Starbucks stock. Okay, so here, this S-Bucks, that's something called a ticker symbol. So when you actually go to invest, you need to know that ticker symbol. You don't actually, on your bank account, your brokerage account, you wouldn't actually input the word Starbucks. You would need to know S-Bucks. Now, it's very easy to go on Google and say, what is the ticker symbol for Starbucks? What is the ticker symbol for Apple? And it will tell you. Okay, that's what that is. This here, NASDAQ, this is the market that stock is being traded on. So there's a few different markets. There's NASDAQ, there's the New York Stock Exchange, there's the Toronto market, there's NASDAQ, Dow Jones. Those are the market that particular company is being traded on. So this company is in US dollars. A lot of companies actually are, and you can, as a Canadian, still invest in the US market. This 88.21, even though it does not have a dollar sign in front of it, that is the price to buy one share, price per share. All right, so that is the price to buy one share of Starbucks at this time. This here is the kind of change. So it's kind of the daily change, which means that, the change in price. So plus 1.62 means that price has gone up $1.62. That is its overall percentage. Generally in stocks, green means it's increasing and red would mean it is going down. Okay, so when it comes time to invest, let's say you had $500 you wanted to invest in Starbucks. All right, Each share is $88, so you'd want to have to do a bit of your math. 88.21. So if I had $500 to invest, I would be able to buy essentially 5 shares of Starbucks. Okay? All right. Hopefully you've watched that original video I gave you here. So when it comes time to investing in stocks, the 2 ways that you can make money investing are through dividends, which is when the company essentially pays out a portion of their kind of overall earnings, or you simply sell the stock at a higher price you bought it at. All right, so let's say I bought into that Starbucks at 88.21. Say 1 year later, each share was then worth $100, and I sold it at that new value. I would have made, $12 per share, right? So it is kind of important to know when to buy and when to sell. All right, so how does selling shares on the stock exchange benefit companies? So not all companies are on the stock exchange. They have to choose to be public. Now, the reason they would want to do that is because when people invest and buy stock in their company, companies are then able to use that money to help the company grow. So companies use investors' money to help the company grow. That's the general idea that a company might want to be on that stock exchange, is to essentially get a little bit of cash flow. Now, as an investor, what is the risk involved when investing in companies on the stock market? So we know that as an investor, we have the potential to give our money to a company. They might grow and we might be able to sell our stock at a higher price, but that is not a guarantee. So there is really no guarantee that the company is going to increase, and we could end up losing our initial investment. So there's a chance, let's think back to Starbucks. I invest when the shares are $88. Years later, the share has gone down to $60 a share, and the company does not appear to be bouncing back. You eventually sell. You have actually lost now the difference there. All right. So in theory, when should you buy and when should you sell? The general idea is buy low, sell high. So you want to buy into the stock market when the company has a low price per share, and hopefully then the company will increase, and you sell when that share has gone high. Now, it seems like an easy concept, but it can be trickier or easier said than done. So, people try to make a living, obviously investing and selling stocks. And so for kind of general people, we have to kind of play it a little bit safe. All right. Now, let's say a friend wants to invest all their saved money in one individual stock. Would you think this is a good idea? Why or why not? So I would say, no, this is a horrible idea. First off, you should never invest all of your saved money in anything. You need to have that emergency savings account or something else. Second off, you should also never invest in one individual stock. You should diversify your portfolio. And we'll talk about that in a bit. Okay, too risky to have all your money in one company. So that's kind of what we're getting at here. So in order to try and protect yourself from some of the risk of stocks, you should have a diverse portfolio. Okay, what this means is you should invest your money in multiple companies instead of just one, and do your research. So that's why stocks are a bit risky. You don't want to just throw your money in any company. You're going to have to do your research. You're going to have to know about that company's future plans. And in theory, you want to kind of invest when the company is new and shares are low, so that hopefully the company will grow. So that can be a very tricky concept. So I personally actually don't invest any of my money in individual stocks, and I prefer funds, and we'll talk about that later. So, Another way to have a diverse portfolio is to just invest in multiple types of investments. So maybe you would have some money in stocks, but then some in mutual funds, some in index funds, some in bonds, and that's a way to kind of naturally diversify. All right, still with stocks here, we're gonna look at these stock charts. Now, these are actually not just stocks. Index funds and ETFs and things like that, they can have similar charts as well. So as I showed you before, there's things called the ticker symbol, which this one is the Apple stock chart. This is the market that stock is being traded on. This is in US dollars. This is the price per share. That's the price change. And what we see here in this graph is the trend line. So the trend line shows you roughly kind of how the stock has been doing. So over here we have the price, and down here we have the time. Now I'm going to just show you one of these in real life. It's very easy to Google these. Okay. All right, I'm going to search, we'll search Apple because that's what we were at. So very easy to just say Apple stock chart, and voila, here we have it. Okay, so Google has kind of their own stock charts built in. So what I want you to see here is we can see all that information that I had screenshot. The trend line that comes up is always 1 day. But notice here how I can click between different timelines. The 5-day trend, the 1 month, the 6 month, etc. All right, if it's green, that generally means it's trending upwards from where it started. And if it's red, it's trending downwards. So 1 day, just notice how we're just talking about time here between 10 a.m. and 4 p.m. We can see that Apple stock started at 317, went up at 2 p.m. to 323, went up at 3 p.m. to roughly 323 as well. And then by 4 p.m., it went all the way down to 318. So stocks fluctuate a lot, right? You don't want to drive yourself nuts looking at this all the time. So these are just general trend lines, but what we can see, they go up and down and up and down. If you click on the max though, we can see that Apple in general, from the start of conception to now, their trend is still very upwards. Okay, this is what I'm talking about. So if you were a genius and you had invested in Apple at 2006, you would have been able to buy in very low, and even today, you'd be able to sell that stock. So it looked like originally in 2006, their stock was $10.90 per share. And now you'd be able to sell that for $318 per share. Oh man, we could have been millionaires. All right. Anyways, so let's look a little bit else here. Let's go into the 6 months trend. What we can see is they were trending upwards, and then all of a sudden we hit this deep dip. So the stock market reflects life, right? So March 23rd was our kind of low point in the COVID outbreak and when the economy took a deep hit, but we can see it's trending upwards, right? So it's important with stocks not to panic or investing in general. You would never have wanted to see this downward trend in March and thought, oh man, I better sell now because I may never get my money back. Well, you would have lost a lot of money. So if you just wait it out, oftentimes our market will recover. Okay, so those are stock charts there. If you're investing, you should check these out. Now, we are going to be talking about index funds. I'm going to show you a different type of stock chart, the Vanguard S&P 500. This is the index fund and the ETF kind of chart. So this is actually where this is showing the market of 500 different companies. So this is a natural diversification called an index fund or an exchange traded funds, and this is what I prefer to invest in. because it kind of naturally diversifies. But it has a very similar chart where we can see the price per share, the overall change, and those trend lines. All right. Where did we leave off here on our notes? Come on. Okay, I think that's kind of all that I wanted to go over today. I will make another video on the rest of the types of investments.